We have a couple of interesting value stock picks that you need to know about, and Tracey Ryniec, our value stock strategist, is the person to tell you about them. She's here with me now. I'm just going to take a shot at this because I've never heard this company before, but Total S.A., TOT, the ticker, is that right?
That would be how the Americans would pronounce it.
Yeah.
Over in France, it is called Total, but it's, a big integrated oil company. They're worldwide. They're kind of like, ExxonMobil of France. In the same space, they have both upstream and downstream. They're big on refining. They have interests in or own over 20 refineries around the world, including in like Africa and China, here in the U.S. So, they make gas, they make lubricants, jet fuel, all that kind of stuff. Mm-hmm. So this is a play on oil prices, because as oil prices rise, a company like this usually does better, but also on refining margins, which have been really good, and they have this big refining business. So that was strong in the third quarter. They report next week on February 13th, so we're going to hear more about what's been happening this last quarter, but based on what the other refiners are saying, it should be pretty good for them. It's not a growth stock. It is value, but not growth. They are only expected to grow earnings about 6% this year, and so far the analysts are only looking at 1% to 2% for next year, because they're just so massive. It's just really hard to find new production, new volumes, and things like that with this kind of company. Mm-hmm. But you're getting like a steady Eddy, because it's not going to be super volatile. You're not going to have like big surprises really in their business model, although there are political risks because they're in companies like countries like Nigeria and places like that. Mm-hmm. So you do have some of that. But that's kind of standard for the course with these big oil companies. The shares, though, have actually traded near a 2-year high here, and it looks like they want to bust out. It's not super expensive. It's only trading a little over 7 times because people just aren't really big into the integrated oil companies right now because you're not getting any growth. But you're also getting a big dividend with this one. So you are getting paid. That. Yeah, you're getting paid to hold it. It's almost 5%, which is much higher than its peers like Chevron or Exxon or the other big oil companies pay. So, they're giving you something for being patient and not getting the growth. But if you're looking for, a big oil company that covers all the areas, this might be one you want to check out.
All right, totally integrated. Okay, anyway, here's one that I do know, Lithia Motors, LAD, the ticker.
Yeah, we've talked about this one a couple times. I keep coming back to the auto retailers.
You do.
Because they're still values. And
I'm waiting for you to tell us why.
I know, well, the story is still good because autos are really hot. During the recession, nobody bought cars, even the used ones. Right. And new auto sales went down to about 10 or 11 million cars in the U.S. They've been slowly rising, which is helpful for this kind of company because obviously they own about 86 auto dealers across the U.S. They do sell the new and the used. They sell 29 brands, both foreign and domestic, so they're in everything. They also do auto repairs. But as the auto sales rise, this kind of company obviously their earnings are going to do the same thing. Mm-hmm. Everybody's estimating that we're going to see about maybe 14.5 to 15 million cars sold in 2013. We were a little under 14 million last year. Okay. So again, the story's still good because the number of cars being sold is still going up. This company has had a super good track record on earnings. They're scheduled to report later this month on February 20th.
Yeah, they haven't missed in 11 quarters?
11 quarters. I put up the chart. You can kind of see I like these earnings surprise charts because there's a lot of green on there. So it's been a couple years, very steady. Share price has also been crazy. I put up a 10-year chart for that one because you can really see at the recession, it got slammed down, obvious reasons, and now it's been on this great run. But it's still value stock. It's still trading around 13 times. It's going to have double-digit earnings growth this year. It is supposed to slow down a bit next year, but we'll kind of see after they report what their guidance is. But, still another 12% for 2013. So you have both the earnings growth plus the valuation, good track record, and then a hot product, basically. So the story's good with the auto dealers. That's why I keep doing them.
Yeah, what's not to like, I guess, right?
Yeah.
Do you own either one?
I do not.
All right. You can check out other stock picks and stock picking strategies on our website, Zacks.com. If you're not there already, get on over there. They change frequently, so you'll want to come back frequently. With Tracey, I'm Terry Ruffalo.